Okay, so right now we are in the middle of a major geopolitical crisis between the USA and Iran. And as always, during moments like this, we see every single time the same pattern. Market starts panicking, media outlets go into a full drama mode, and most investors and traders end up losing money. But after several years of trading and studying these financial markets, if there's one thing I've learned, it's this. Every crisis, without exception, creates massive opportunities. And the real question is not whether opportunities exist, but the real question is rather where you should be looking. And that's exactly what we are going to do in this video. We are going to ignore the noise, ignore the opinions, ignore the social media chaos, everything, okay? And focus only on facts and market signals. But before diving into the markets, let's recap quickly how this conflict actually started. Everything really escalated on February 28th when the United States launched Operation Epic Fury, initiating military strikes against Iran. The official objective from the US side was clear: to neutralize Iran's nuclear program after diplomatic negotiations had failed. In other words, diplomacy stopped working and missiles started flying. But what truly escalated the situation was Iran's response. Iran not only responded militarily, but also made a move that shocked the global economy. They blocked the Strait of Hormuz. Now, if you are not familiar with it, the Strait of Hormuz is one of the most critical oil transit routes on the planet. A huge percentage of the world's oil supply passes through that narrow corridor. And as I'm recording this video, it's March 19th, day 19 of the conflict. Traffic through the strait is almost at a standstill. Needless to say, global tensions are extremely high. And now that you understand the starting point, let's talk about the current situation. But instead of jumping straight into asset prices, I first want to look at this market sentiment. Because sometimes sentiment tells you more than just price itself. And at the moment, the latest developments shows that the United States has tried to calm things down. But what is it the problem? The problem is Iran didn't even respond. So after that failed attempt, the US just tried another approach. They asked France to act as a mediator and open a communication channel with Iran. And this time, Iran did respond. But the answer was simple. The objectives have not yet been achieved. And that one statement tells us something extremely important. It suggests that Iran likely has a larger strategic plan. And that plan may go far beyond military operations. It may actually aim at something much bigger: a prolonged global energy crisis. If oil prices just explode and stay elevated long enough, the economic pressure on Western economies could become massive. And based on recent developments, Iran seems willing to endure short-term pain to reach that objective. And at the same time, diplomats from neighboring Gulf countries are just trying to find a diplomatic exit. But their position is incredibly complicated. Unlike the United States, which is geographically far away, Gulf countries are literally Iran's neighbors. And because many of them host US military bases or maintain strong economic ties with the West, so with USA, they are indirectly exposed to retaliation. So the room for negotiation is limited. So what is the overall sentiment right now? The United States want to de-escalate. Iran is refusing to negotiate, and it increasingly looks like they are playing a longer strategic game. So now, if we look at the fear and greed index, particularly for the S&P 500, we can see that sentiment is currently in extreme fear territory. But here's the interesting part. Despite all this tension, the S&P 500 is currently only about 5% below its all-time high. Okay? You can see over there 5%. And at some point during the week, it was only at 3.5% down, which honestly is a very small correction considering the potential geopolitical risk. We have seen much bigger drops in the past, of course, for example, November 2025 correction or even April 2025 drop triggered by Trump tariffs, which reached nearly 20% down. So compared to that, a 5% pullback is almost nothing. Which brings us to a key point. As traders and investors, our job is to filter the noise. And right now there's a lot of noise. Fake news circulating online, manipulated image, viral content designed purely to trigger emotional reactions. And at this point, you could literally scroll on social media and see absolutely anything. Yesterday, I even saw an image of an Iranian man on a flying carpet attacking fighter jets. Welcome to the internet. But jokes aside, most information circulating right now is pure noise. And if you try to trade every headline, especially political statements, you will get destroyed for sure. So let's be honest, if you follow every tweet or statement from Donald Trump, 95% it's noise. And sometimes it's even market manipulation. So now you have two choices. Option number one, scroll Twitter, react emotionally to every headline and behave like the majority of investors. Or option number two, step back, focus on measurable facts and analyze what it actually drives this market. Personally, I choose option 2. And when you do that, you quickly realize that right now, 3 major facts matter. Fact number 1, everything revolves around oil. And right now, the most important chart in the entire financial system is the price of oil. If you are a trader, the only chart that absolutely must be open on your screen right now is oil, because almost everything else is reacting to it. And so when we overlay all the charts, we see something fascinating. Oil prices and the S&P 500 are currently almost perfectly inversely correlated. And look, when this oil just pushing, boom, my S&P 500 is in blue right now. So you can see that every time that oil pushes, boom, this S&P 500 is going down. And every single time that this oil stays flat or just dump a bit, boom, this S&P 500 go to the upside. And we also see the same relationship with the US dollar index, which is in green. Right there you can see. So when oil rises, the dollar tends to strengthen too. Look, just over there on this push, on this oil, and boom, in green, this dollar starts to getting stronger too. And the same when oil just drops, this dollar tends to be weak. And for example, over there, he's making new low. And the same pattern appears with US 10-year treasury yields, which are historically correlated with the dollar. So again, oil is the key variable right now, because it's him which is moving every other market. And this is why I always say something very important on this YouTube channel. Even if you trade only one asset class, doesn't matter if it's Forex, indices, crypto, you must understand the other markets, because finance is an interconnected system. Oil impacts currencies, currencies impact bonds, and bonds impacts equities. That's why everything is connected. Even gold, which is considered a safe haven, is behaving differently right now. At this moment, gold is acting like a risk asset. When we overlaid this gold in blue with oil, we can see that this gold is moving like the S&P 500 and the risk assets and all the equities. Look, when this oil is pushing, bam, this gold is dumping. And this leads to an important risk management lesson. If you are going just long on oil, short on gold, and short on this S&P 500, you might think you are taking 3 different trades, but in reality, you are taking the same macro trade 3 times, which means you could accidentally overexpose your portfolio. Fact number 2, global interest rate expectations are shifting aggressively, because just 1 month ago, if we are taking the 29th July 2026, we were expecting rate cuts from most major central banks, especially the Fed central bank. Look, right now, the current rate is they are between 350 and 375, and 1 month ago, so the 19th February 2026, we were expected that for this summer we had 45% of chance to cut about 0.25 BPs this interest rate, and right now we have 83% of chance that we're gonna hold it this rate, and we can see that right now this scenario has completely changed, because if oil prices keep going, inflation could come back, and central banks would be forced to keep this interest rate higher and longer. And we are already seeing this repricing across the Fed, as I showed you just over there, the ECB, the Bank of England, the Bank of Canada, and even the RBA. And to push this example even further, we can go at the end of this year in 2026, so the last FOMC day of this year, it will be in the 9th December, and this repricing has already taken place over there, so we will have 61% of chance today, so the 19th March 2026, to keep to the same interest rate than we have right now, so between 350 and 375, and that's why it's not a good thing for risk assets to go higher and for the growth. And that's a complete 180-degree shift in expectations. And the macro chain behind this is actually very simple. Oil goes up, energy costs rise, and when energy costs rise, everything becomes more expensive. Transportation, production, logistics, that pushes inflation higher. And when inflation rises, central banks cannot lower rates. In fact, they may need to raise them instead. So that macro chain is oil, inflation, rates, markets is currently driving everything. And everything else is just secondary. And now comes the $1,000,000 question. Will oil prices continue rising, or will they normalize? No one knows for sure. But here's my personal theory. I believe the United States expected a short demonstration of force, a quick operation, a show of power, and then a rapid de-escalation. But I think they may have underestimated Iran's determination and preparation. Iran may not be playing a military game. They may be playing an economic chess game. And the objective might be to create enough pressure through an energy shock to weaken Western economies before negotiating, which means tensions could last much longer than markets currently expect. And earlier, I think it was last week, Donald Trump just said the war could end very soon. And surprisingly, markets believed it. The S&P rallied, and personally I just used that rally over there and over there to open short positions in scalping and even in day trading, because I simply don't believe that this conflict will resolve that quickly. And now, obviously, analysis is important, but as traders, action matters more. And if we believe markets mispricing a situation, we need to position ourselves accordingly. And if tensions continue, there are two main ways to approach this. And the first one is hedging. If you already have a large long-term portfolio heavily exposed to equities, you might consider hedging by shorting indices like S&P 500 or Nasdaq. And that way, if the market drops, your hedge offsets some of the losses. And the second one is just directional trading. And if you are not already exposed, you might simply take short positions on indices if you believe energy energy prices will remain elevated and risk sentiment deteriorates. Because again, remember, so far, the stock market has barely reacted. And interestingly, this situation doesn't surprise me that much. In my trading live stream on Phidias Profim YouTube channel, I share with you guys often my analyzed valuations, my macro positioning and sentiment, and I explain you why markets could face significant pressure in 2026. And one of the reasons is the midterms. We know that these midterms, the presidential midterms, are often a bearish year. So this geopolitical crisis right now could simply become the catalyst that we are waiting for. And beyond equities, we could also see opportunities emerging in energy, commodities, and related assets. Oil, obviously, but also other energy-linked markets. And those are areas that I'm currently watching very closely. And now, of course, this video is not financial advice. These are simply my personal thoughts as a trader analyzing this situation. And like every trader, I've been wrong many times before. But if I could give you one piece of advice today, it would be this. Don't get trapped in the noise, please. And don't get emotionally attached to the headlines. Step back and think about the macro consequences in 2 months, 6 months, or 1 year. Think about the inflation, think about the energy costs, think about the interest rates that all this inflation is gonna make as consequences in the economies later. And that's how a trader is thinking. And it's not about what the politicians say today. And because right now your compass is simple, watch oil. Oil drives inflation, inflation drives interest rates, and interest rates drive the markets. Let me know in the comments if you enjoy this type of macro breakdown content, and of course don't forget to put a thumbs up, subscribe to this YouTube channel because a lot of things are going to come, educational content, entertainment content, and of course we are in live trading live stream absolutely every day from Monday to Friday on the Phidias Profim YouTube channel. So if you are curious to watch me how to trade and have fun in the same time, boom! It's on the Phidias Profim YouTube channel. That's everything is happening. See you in the next one. It was Florian Trader. Take care, trade safe. Bye bye bye.
Yo, his name is Florian. He's the NASDAQ hustler. Every day he's grinding, making all them numbers cluster. He's a day trader, living life as a thrill seeker. Analyzing charts, he's the Wall Street sneaker. 9 to 5 ain't his game, it's the stock market flow. Tickers on his mind, watching those numbers grow. Buy low, sell high, that's the name of